What's up, everybody, and welcome to the Prosperity Through Multifamily Real Estate Investing podcast. We have a very special guest with us today. Joining me today is Mr. Josh Plave. Josh, how you doing today?
Hey, Cody. Thanks for having me.
Yeah, man, I'm super excited to have you here. I'm really excited to jump into your background and our particular topic today, which is leveraging self-directed IRAs to invest in commercial real estate. And so for my audience, anybody that's followed the show, we've kind of talked about this topic in the past with an actual custodian, but I'm really excited to have you here because we're going to be talking about it from the aspect of an investor yourself. And so, but before we get into that conversation, a little bit more about Josh. Josh is a multifamily syndicator who specializes in helping investors use their retirement funds to passively invest. Through his company, Wall to Main, Josh provides all of the tips, tricks needed to invest quickly, safely, and inexpensively with an existing retirement account. So again, Josh, welcome to the show. Tell us a little bit more about your story.
Thanks. Yeah. I promise it doesn't sound sexy, but it's very effective. And once you get it down, it's a great driver for your overall generational wealth. So, kind of my backstory. I got started when I was 16 years old. My mother and my grandfather were both CPAs, and they kind of had this, forward thinking, or future minded mindset, and they always advocated for me getting started early with investing. And what I ended up doing actually was because I had done a camp counseling job that summer. I decided I was going to open up a Roth IRA at 16. And so I opened up my account pretty early, and I invested in what I knew at the time. I was a huge aviation geek, and I loved airplanes. So I invested in a mutual fund that was airlines and aerospace defense. So I always advocate for investing in something, I knew this sector. So just put like $1,000 in there and got started at the time. It did pretty well for the next 15, 20 years that I had it. And in the meantime, I had, continued to put stuff in there and just continue investing and understanding how to generate the compounding value of the dollars I was earning at the time. So, okay, sorry. So the upshot of that is that about 8 to 10 years later, my mother and my grandfather, who I mentioned, they had actually both passed away. And what that did was leave me with the retirement account, of a baby boomer and someone from the greatest generation. And so essentially, it wasn't a life-changing amount of money, but it was enough that for both myself and my sisters, I needed to understand how to be a good steward of what they had done with their entire lives, everything they had earned and what they had set up for themselves, but also knowing that it was eventually going to get passed down. And so I needed to make sure I was, really covering all bases, looking at what I had available to me, what I could do with them, not just jumping after the first hot, shiny object that was presented to me in front of at a seminar. And so I spent the next 2-3 years diving into everything I could possibly do with these retirement accounts. And the information's kind of scattered all over the internet. So what I did was I started Wall to Main because I wanted to specifically come at it from an investor standpoint. So investors knew all of the pieces, all of the picture that they need to take a look at, and have all the little bits of information that they can properly leverage to make the most of their current accounts that they have right now.
I love that. And I got to tell you, so I'm a little embarrassed to say this, but I kind of feel like I'm failing my son now because my son's about to be 16. And I promise you, he's not thinking about self-directed IRAs. He's thinking about how he can go get a cheeseburger down the street for a couple of bucks. But we're working on it. Okay, we're working on it. But
that's all it takes.
But no, man, listen, that's really cool and very interesting. Again, at 16 years old to be already investing in, your retirement accounts that you were learning how to leverage, and unfortunately through tragedy, you had an inheritance and whatnot. But I mean, just, it's really inspiring to hear that, somebody like yourself at such a young age was able to start that development and that maturity. And I mean, obviously it's paid off for you now. You have some success, and you're doing great things. And so kudos, man. Really excited about that.
Thank
So
you.
I'm going to make my son definitely go back and listen to this episode. You best believe.
So, yeah. I mean, if you have anything put away, it doesn't take a lot, but it's very, very powerful for your future self if you get started as early as possible.
Yeah. You know, to that point, and I hope that for the parents that are listening on the show, which I, imagine there's many like myself who have young children, my son being the oldest at 16, but, you know, this is such a great way to get them started as well. Like you said, such an early age, and let it build and whatnot. And such a powerful strategy to be leveraging for your children, and whatnot. So, but, well, cool. Let's kind of dive right in then. Let's talk about a little bit about the basics of a self-directed IRA. Again, for the audience, we've kind of addressed this before in the show, but just maybe we have some first-time listeners. Let's talk a little bit about self-directed IRA, and then we could kind of go a little bit further into when it's good to use it. So,
Yeah. So really quickly, since I guess most of the viewers or listeners have probably heard this, you can use a retirement account to invest in virtually anything. There are very few limitations. Whatever you think is a good investment is fair game. You just can't invest in like collectibles, art, jewelry, stuff like that, life insurance, and shares in S corporations. So if it's not one of those three things, you're good to go. I've heard people investing in racehorses, all kinds of wacky stuff. So whatever you want to do. But basically, you need to have the account in your control. It can't be at like a 401k with an existing employer. Those typically, some of them allow for it, but what's called an in-service rollover, but most don't. And so you would need to have it kind of from a past employer or an account that you've already established yourself. And so at that point, you'll be able to really take control of it and self-direct. So if the account you're thinking of in your head is with a current employer, you can ask, but there's a good chance you won't be able to make use of this. But someday it's worthwhile to come back and check into it. So what you do from there is, we all typically have our IRAs, 401ks, 403bs at custodians like Vanguard, Schwab, TIAA. Their brokerage houses are structured around stocks and bonds, other equities. So they don't typically allow for you to trade in alternative assets that we're talking about. And so what you need to do is, there are other custodians out there just like that. They're geared towards the whole gamut of everything that you want to do: cryptocurrency, gold, real estate, whatever it is. And so you need to move the money over to one of those custodians. You've had one of those custodians on the show. Personally, as an investor, I like to take it a step further, and actually, I advocate for checkbook control. What happens is, there are companies out there who will establish a custodian account for you, but then at the same time, they'll also establish an LLC for your IRA. And what that does is, when the LLC is established, you're able to take 100% of the funds from the custodial account and invest them directly into the LLC. It's the only investment that the custodian account's going to make. And then you have direct control over that LLC. So you can go and open a bank account, and you can treat it like really any other business. There are rules, structured around, how you can actually operate with the money, but it's just like any other business. The expense and income flows through that LLC. You control it. You only pay wire fees to actually transact, and it's very cheap. It's very quick, and I found it to be the most effective when actually using it day to day in real estate.
I really want to come back to this topic because I was introduced to this topic when I heard you on another podcast, and I was like, I have never heard that before. So always very intriguing to go down that path. But I want to kind of scale back and jump back real quick. In speaking to, those who may still have a W-2, again, they have a 401k, 403b, through their employer. Any recommendations that you would be willing to give for those who are kind of maybe stuck in that situation, but really want to learn more about this, the strategy, how they can implement it? And a little tidbit again for the audience, Josh is not a professional advisor. We recommend, obviously consult your professional licensed advisors, CPAs and whatnot before any of this. But anyway, Josh, please continue.
Yeah. So if you're in that situation and you think that you probably won't be able to use the funds that are in the bulk of your 401k or 403b with a current employer, the main thing is, you need to contact your administrator and ask for an in-service rollover. Some of them, if you're 50 and over, they'll allow for it, but the majority don't. If you do end up moving employers, the one big tip is that you shouldn't, if you intend on using it to self-direct and invest in real estate or whatever you want, you should not actually roll those funds over to your new 401k because you've then relocked them. Once you left the employer, they're now free to move and you can actually take control of them and move them to where you want. A lot of people, accidentally, they realize after the fact, maybe a couple of years later, it's something I did, realized after the fact that, hey, I got a new employer, I had a new 401k, I moved my old 401k to my new 401k, and now it's with the current employer and it's actually relocked again. So you're kind of in that cycle. So if you do leave the employer, just make sure you kind of take it away from that administrator. If you're no longer with the employer, they tend to charge pretty exorbitant fees because you're not part of the plan anymore. So just at least move it away into your own control if you're not ready. And at that point, you can, when you are ready, you can move it over into one of these self-directed accounts.
Yeah, great advice. I'm glad you mentioned that. That's actually the exact way we were able to leverage one of our self-directed IRAs. By that way, is rolling it over in between employers. So good advice there. And in speaking to what we find ourselves in now with the COVID pandemic, there was a really big uh, provision in this CARES Act plan that allowed people to access their retirement funds under certain circumstances. I think, if I'm not mistaken, we're kind of past that window now. But do you have any insight into that benefit?
Yeah, if you happen to be listening to this before the end of 2020, you still have an opportunity. It was part of the CARES Act, and you can take out up to $100,000 from your 401k from your current employer. When it first came out, we were all really jazzed about this, and it's a great opportunity. The tricky part around it is that the employer actually needs to opt into this program. And so they need to actually say, hey, this is allowed. And we've found that some employers are playing ball and they're okay with it. But I've gotten a lot of feedback that people are getting pushed back because, administrators don't want to have less funds under management. So that's kind of how they get their low fees. So if they start letting funds slip away from their control, then they're not too happy about that. So we haven't seen a 100% success rate with it. But it's really nice because you can actually do what's called a coronavirus related distribution, take it out. You can either pay the income tax over 3 years. There's no early penalty, so they waived that, the big deal of it. But then you can either pay the income tax over 3 years in 1/3, or you can actually move it into a new account that you open up yourself. And so you could open up a new IRA or a solo 401k and move it over to those places and actually never have to pay any income tax at all. It's just reclassified into another retirement account that you now have control over.
Yeah, man, that was such a powerful provision for many people, and what a great opportunity as well. To tap in, especially if you have any significant 401k funds sitting there and you really want to leverage that. So, um, appreciate you insight. I knew, I think I was like, man, I think the date's coming up pretty soon, but I thought it already passed. But I'm glad to hear that we still have a time. And this episode will definitely air before the end of 2020. So we'll make sure that
Right? Is that small window?
that's
Yeah.
out there. So, um, great, cool, man. So I want to go back. So as an investor, this is a great strategy to utilize with the self-directed IRA, especially if you're okay with staying in the W-2 and you're just wanting to leverage these retirement funds. You're not touching them anyway, right? So it's a great way to leverage that capital that's sitting there. Maybe you just don't have the liquidity sitting in your bank account, but you do have this IRA fund. So it's a great strategy there. Um, you know, maybe that's all that you have as far as capital to invest, right? I mean, so it's a good way to get started, but it's not a fit for every situation, and um, there are some nuances with utilizing a self-directed IRA. So let's kind of dive into that. So let's talk about when is the right time and when is not the right time to utilize your self-directed IRA.
Yeah, I mean, one of the reasons I like speaking to this is because it is the largest source of wealth for most Americans is their home, the equity in their home. And then the second one is their retirement accounts. There's actually more funds in retirement accounts than just in cash or brokerage accounts. So people have access to a lot of funds that they maybe wouldn't have in savings. The flip side of that is, if you have a lot in your retirement account, but you don't have a lot in savings, and sometimes you might be trying to lean on those as a backstop just in case something happens as part of your savings, and you want to take out some contributions and use that as an emergency slush fund. If that's your case and you need to use a large portion of those as kind of your backstop, I wouldn't really, get too heavily invested in this, because you want to make sure that you are not putting in your entire net worth into any kind of investment that, especially I specialize in multifamily, it's fairly liquid. And, for most investors, it makes sense because they're not going to be touching their retirement account for 20, 30 years. But, so they don't mind the 5-year illiquidity. But for those who are thinking about potentially using it to pay, for their first home purchase, or for medical costs that are coming up, if they're thinking about that, you can do, you can either say maybe this isn't right for me, or you can use a portion of the funds for real estate, and a portion of the funds you leave behind in a typical IRA or 401k, and you make sure that they're in the more liquid stocks and bond situation.
Mm-hmm. Yeah, that's a great point, and I'm glad you alluded to that, because it's very easy as you learn about this world of real estate investing and being able to utilize this avenue. It's surprising to me when I have these conversations with people, just how many people don't know about this strategy. They've never heard of a self-directed IRA, and being able to take control of that investment fund. It's very easy to kind of build on that excitement and want to get into an opportunity, but you definitely have to be strategic. And I think as operators, syndicators ourselves that are raising money from others, it's also prudent to be good fiduciaries as well. Making sure that your investor situation. You don't want to be taking their last bit of funds if they're, if that's all they have. You really want to make sure that you're looking out for their best interests. So, and sometimes that means not taking it, but
yeah, whether it's cash or retirement, you don't want to put all of it into just the one investment.
yeah, great point. Great point. Um, cool, man. So in addition to that, there's also some other, business related taxes and things like that. So, you know, even though the self-directed IRA is in a tax advantaged account, it doesn't mean it's completely tax free,
Right.
right? So let's kind of talk about the nuances of utilizing a self-directed IRA.
Yeah. So there's two different accounts. There's the self-directed IRA and there's the solo 401k. And most people, think of a retirement vehicle as a totally tax-free environment. So the solo 401k, which requires self-employment income for you to sponsor, that is totally tax-free if you're investing in multifamily. If you can't generate self-employment income, or you have a Roth IRA or an inherited IRA, those are going to be stuck in a self-directed IRA. And so you need to kind of come to terms with the fact that there are actually taxes that come into play when you invest in a leveraged asset. So what happens is, let's say we're buying a building with a 25% down payment, 75% leverage, pretty typical. And so part of your retirement account is part of that 25% equity. And so when you invest in a multifamily property, 25% of the income that comes in is generated just purely by your equity. And so that's never taxed. But when you're looking at bringing in outside funds from a non-tax deferred environment, so a lender comes in and brings in current day money, not your retirement dollars, and they're helping you generate income for your retirement account, the IRS is okay with that. They just say you need to pay taxes on that situation. But luckily, you only need to pay taxes on that portion of non-tax deferred dollars coming in. So let's say for the first year, we have 75% leverage. You're going to have to pay taxes on about 75% of all the income that comes in. The nice thing is, actually, it's kind of unknown, but because of that, the 75%, the non-tax deferred dollars, I can actually make use of depreciation, operating expenses, and any other losses, just their prorated share. So it helps to offset things pretty well. What you end up doing is you earn, it's called unrelated debt financed income. So that's UDFI. And you end up paying unrelated business income tax, or UBIT. And so a lot of folks, they pontificate and they make it sound really scary, and they talk about how UBIT's kind of destroy all of your returns and you should never invest in a leveraged asset. But I got really kind of tired of people sitting there and saying you should blow up your IRA or you should move it into this and trying to sell people and stuff. So I ended up actually creating what I believe is the industry's first UBIT calculator, because I just wanted like a hard number behind stuff. I'm a numbers guy, so I wanted some solution. So I spent a while building this. It's a gigantic Excel spreadsheet with like 48 inputs. And what I end up doing is I'm able to plug in the offerings that I provide to my investors and let them know what, not just projected earnings are, but projected taxes, what their total take home would end up being if they invest with a self-directed IRA. And so what I found through the UBIT calculator is that, for the first 3 to 4 years, those expenses I've been talking about, they're actually able to offset pretty much the majority of the income that you have. So for the first 3 to 4 years, either it's $0 tax situation, or it's really small for $100,000 if you're getting like $10,000 every year on let's say 10% cash on cash. You're probably going to look somewhere between a $300 and $1,000 in taxes. It's not a huge number, pretty small. The big number is on the capital gains event. So on a sale, proceeds from a sale, or let's say a refinance above your original capital account balance. That situation, when there's a capital event, you have to pay a large sum of UBIT. And so the nice thing is when you annualize it out over the life of an asset, we're actually finding that it affects things by about 4 to 6% annually. And so if we're seeing something between an 18 and 20% return on an asset, that's going to be somewhere between let's say a 14 and a 15% return still with your self-directed IRA. And so for the most part, it's still a worthwhile investment. We've been able to find certain types of investments that are most perfectly suited for self-directed IRAs. They're not all perfectly aligned, but with the calculator, I've been able to kind of figure out exactly, which assets we should target.
Yeah, I like that. And just out of curiosity, this UBIT calculator that you have, is this something that you're putting out there for others to utilize as well? Are you marketing that at all, or?
I would love to find a way to actually make it, to monetize it or sell it to people and let other people use it. As I mentioned, there's like 48 inputs into it. And so there's so much data that comes into understanding kind of there's certain ratios and there's certain different factors that come into play every single year and adjust and slide every year. And I also have it accounting for refinances if those occur. And so there's so much stuff. It's just an ugly, not sexy looking spreadsheet. And I don't really know what to do with it other than, provide it to my investors to give them a better picture of what's going on.
Yeah, so maybe a little way too complicated for people like myself who are not Excel experts.
I can certainly run something for you, but yeah, I'll figure it out down the line. But yeah.
Yeah, hey, I mean, it sounds like a very powerful tool to use, and I mean, like, as you mentioned, we're all about doing our best to project returns, right, based on the performa and performance and things like that, and even with depreciation schedules, cost segregation studies, things like that, we're always trying to get an idea of what that looks like for the investors, like you said, because it's good that it's more information that you can show them, like, hey, look, this is what your return is. But in speaking to this, in understanding that, hey, this is a tax occurrence that you will have to pay, it's good for them to be able to be prepared for that and see that. And having something concrete is better than, or having something visible that they can see as a reference is a lot better than not knowing till the end at the capital event. And you're like, where did that come from?
Absolutely. I appreciate folks who give the full perspective, people who talk openly about recapture on depreciation. I always appreciate that because people talk about these gigantic cost segregation studies and they help with your taxes, but at the end, there is some sort of a recapture on it. So giving the full perspective to your investors is great. It's kind of caught me in a bit of a pickle because I'm able to see or get an idea of if something is going to be good or not. And so I've had plenty of deals come past or come across my desk in the last few months, and the lending environment is just such that it's not really well suited right now for retirement investors, just because I personally try to find investments that they utilize bridge debt, and so they aim to refinance somewhere around year 3 and return 40-50% of an investor's capital, because that way that's not affected by UBIT. And so just a return of capital isn't hit with taxes. And so if you're able to get 50% of your capital back halfway through the deal and then go and utilize that to move into another opportunity, you can really maximize the value of your dollar before you're ever getting taxed. And so right now, just because of the COVID situation and uncertainty with lenders, we're not finding a ton of bridge debt. It's out there. It's just kind of hard to hunt down for certain deals. So because I'm seeing more agency, I'm actually having to turn down more and more deals and not bring my investors to them.
Wow, interesting. Interesting. We could dive in that a little bit later too. I'd be interested to
Yeah. It's
see
kind of
what
a
you got.
new, it's a newer thing that I've come across, and it's unfortunate, but if you, everyone has to come up with their guidelines and their investor, standards, and you really shouldn't shift away from those unless you see a really prudent opportunity or a good reason to move away from them. But I'm trying to stick to my guns.
I really like that, and I appreciate you mentioning that because we're seeing a lot of that right now, as you mentioned. I mean, there's a lot of the way these deals are transacting. It's hard to make sense of it, and I think a lot of that is a lot of people have been sitting on the sidelines for most of the year, right? There's obviously most of us have being forced to,
Yeah.
but now that deals are coming back to market, it's just everybody's getting so excited, I think, and you have a lot of capital coming into some of these markets that weren't there before, and so I don't know. It's just uh, point being, be patient. I think is the big thing right now is be patient and stick to your guns. There's always going to be opportunities down the road, but the more information that we have, the more that we can analyze and make a good decision, the better off you'll be, and the better your investors will trust you. So
Yeah, absolutely.
I appreciate you mentioning that. So well, cool. I want to go back to this checkbook control that you mentioned.
Yeah.
Again, new concept for me, and so I heard it. I heard you talk about on another podcast, and I'm really interested to pick at that a little bit more. So just to kind of recap what you mentioned earlier. So I can create an LLC for the IRA. Okay, and you said the income and expenses flow through the LLC. What happens to the funds or the dividends that's paid back to the IRA? Is it still going to the IRA like if it were just regular self-directed, or?
It goes straight into that LLC. You can eventually move it back into your, actual IRA account if you'd like. Um, there's not necessarily a need to. A lot of custodians actually, checkbook control stuff, custodians, they'll allow for not just real estate, but you can actually still do stocks and bonds. And so while it's sitting there and you're waiting for, let's say you have $1,000 in rental income come in. I mean, you can't go and invest, $1,000 into another real estate property. What do you do with in the meantime? You can actually go ahead and invest it in, the usual mutual fund situation you would do. You can attach a brokerage account to it. It's pretty flexible. So there's a lot of options.
That's really appealing to me because with your self-directed IRA, the IRA is making dividends, but it's sitting in the IRA. You can't touch it, right? All you can do is continue to reinvest whenever you've built up enough capital. But if I'm understanding you correctly here, the dividend that's paid to the LLC, you can then leverage to move to another asset.
Yep, absolutely.
That's really cool. I like that. So
If
so
you're
how
into
do
crypto at the same time, I mean, you can go and buy crypto at the same time. You can do all kinds of stuff, different asset classes at the same time, whatever you want.
that's so cool, man. I love it. So how do we get that set up again? Is it through a custodian, or is there, can every custodian do this, or?
So there are certain custodians that specifically are set up for checkbook control. One of the ones that I use is Rocket Dollar. Big fan of them. They're all digital, electronic stuff. It goes pretty quick, um, and it's the cheapest I've been able to find. I think to open an account it's $360. I've got a $50 discount if anyone wants it, and then it's like I think it's $15 a month, so it's like $180 a year. So that's pretty cheap. Then there are other companies, other vendors I've used to open up my family's 7 accounts. We actually used a company called Safeguard Advisors. And so they're kind of more a full service boutique where they're going to they have a direct relationship with a custodian. And this custodian usually doesn't do checkbook control, but they've established a relationship to allow for, to facilitate this. So they established a custodian account, and they also have attorneys on staff to open the LLC for you and kind of help flow from old custodian, new custodian, LLC, and make sure they take care of all the steps for you. And the nice thing is because they are opening up the LLC, they can advise the LLC. So most custodians, they're not fiduciaries. They actually they're not obligated to give you investment advice. But the nice thing about this situation is because they're able to advise the LLC, they can let you know if you plan on going into multiple asset classes and want to get a little creative with your investments. You can reference back to them and say, hey, is this kosher? Is this something that the IRS is going to allow for? There are disqualified transactions and other people that you can't invest with. But they'll be able to advise you on that kind of in perpetuity as long as you use the account.
That's I like that. That's really cool. I
Yeah,
like that.
nice.
Um, And so it's so relatively low cost to set up, like you mentioned, and low maintenance costs here, and you're paying for the wire fees. But aside from that, you know,
Yeah,
it sounds like comparing this to just your traditional self-directed, the fees structure seems to be very, very much similar.
yeah. The nice thing is that with the fees, you don't really have you don't end up having like reoccurring fees. So with custodians, they typically will charge per transaction or per every time you want to do a transaction, they'll charge like $95 for a application fee or something. And then they also will charge an annual fee, or they sometimes base it off of the asset price or overall asset values. So it kind of gets very overhead heavy. And so you end up having a lot of those costs. And the vast majority of the checkbook accounts I've seen either have an annual cost or they have like a monthly fee.
Gotcha, gotcha. All right. So, so Josh, we've been spending a lot of time talking about the IRA. Love it. I mean, you put it in a way it's clarifies a lot of questions I think a lot of people have. Well, let's talk about how it's directly impacted you and your business as a real estate investor. I want to know about your kind of portfolio, how you've utilized this strategy, and you know, tell us, give us an example of some success stories that you've had.
Yeah. So one thing I really liked is so when I ended up kind of learning about everything I had to do and where I wanted to head, I eventually landed on multifamily to start. I originally thought I was going to flip. I thought I was going to do all kinds of stuff. And I settled on multifamily because, of a myriad of reasons. But anyways, I knew it would take a long time to kind of set up. You have to analyze 100, 200 deals for anything to really click. And so I knew it would take a bit of time, and I was able to leverage other opportunities. So I ended up doing private money lending with our retirement accounts in the meantime. Private money lending, it just earns an interest rate. It's not subject to UBIT. There's no taxes, and it's totally passive. I found a friend of mine who happened to be invested in Boston, where I went to college, and he was flipping properties, and so I was able to lend him and his buddies some funds, and they're able to use those funds to build something beautiful, and they pay me back at a decent interest rate, and that was able to keep my velocity of capital up while I was waiting to deploy it into multifamily. So that was nice, and since then I've deployed it into multifamily, into some really nice value add opportunities that aim to refinance early on. I invested hopefully to minimize our UBIT impact. And that one was in Memphis, and they're putting in $25,000 a door because the property was in a shambles, but it's an amazing opportunity, and I'm really happy to be a part of it.
That's awesome, man. That's great. That's great. And would you say, with your experience with these self-directed IRAs, when you're going out there targeting passive investors, would you say that that is your niche? Are you specifically targeting retirement accounts like this, and or
Yeah, that's kind of what I'm trying to do is enable other folks to understand how they can. I've talked to a number of people who didn't think they could actually get started in real estate or in multifamily because they knew there was a high minimum investment, typically 50 or 75,000, and they didn't have that saved up. But they've heard me talk about the fact that you can get into it with retirement accounts, and so they were able to utilize those. So it's nice in that regard. It also is also it opens up people to understanding what they can do with cash as well. But the really interesting thing is a lot of folks talk about raising funds and the difficulty in getting people's minds around the liquidity of a multifamily investment and how you might be in for 5-6 years. I have literally gotten not a single question on this topic from any of my investors because they all intend to have this capital in there for another 20-30 years, and they don't really mind the next 5-6 years if it's in these accounts. So if you're finding the right investors who aren't trying to they don't need to, like as we mentioned earlier, they don't need to have access to those funds in the immediacy, then it's been really interesting because people are totally fine with a really long hold period because they don't really mind what's going on in the meantime.
I mean, they can't touch it anyway, right? It's just
Right.
sitting there anyway. And if you've seen what's happened this year, where the retirement accounts were really almost wiped in half, I mean, it's a better option as far as more stable, predictable cash flow, right? So
Right. I mean, I have one stock, one mutual fund left. I've barely had to worry in the last 2 weeks as the market retanked. I don't have to lose sleep at night knowing that, I have to worry about the next day and what the market's going to do. I know while I sleep, my multifamily investments are making me money in the meantime. So it's soothing for my mental state.
Yeah, it's nice to be able to sleep better at night knowing that your assets and your wealth is a little bit better controlled than, I mean, obviously you're controlling what you're investing in, right? You're controlling how you're investing in, and yeah, it's not full on bulletproof per se, but at the same time, it's a lot less susceptible to a lot of these outside factors that we have no control over, right? And so that's my pitch to people when we talk about investing in real estate, because you hear it all the time. Well, isn't that risky? And it's just like, well, consider this alternative, and especially with a COVID pandemic. I mean, we don't want to highlight anybody's, struggles through this pandemic, but it's like, where's the security in that? Where's the security in knowing that one day your job can just be gone at the drop of a hat, or your retirement account slashed in half because of their global trade war or something like that, so
Right.
anyway, I'll get on a soapbox. I digress a little bit. I apologize. But so as a operator, as a syndicator, as a fiduciary of other people's money, as you're going out there and you're educating people, what are some of the most effective ways that you're educating people about the power of, you know, retirement accounts to leverage your investing?
It's building a series of investing, I guess, goals and guidelines of what you're trying to do. It's really interesting as I've gotten more involved in this, seeing people's requirements. So, for example, if you're over 59 and a half, you can start taking distributions from your retirement account. And so with my older investors, I actually like to advocate looking for deals that cash flow on day one. A lot of opportunities, they won't cash flow. You won't have distributions for the first year or so as they, implement that value add piece. And so for the older folks who may want some income to supplement their day-to-day lifestyle, we like to invest in cash flow opportunities because they'll actually get distributions and they can then take a distribution from their retirement account and use that as day-to-day income in a way that most investors couldn't. With the other ones, there's a different goal where you're trying to maximize your equity multiplier. You're trying to make sure that you just kind of build the account as greatly as you can. And, there's different set of guidelines. As long as you can kind of come into the situation and understand what you need to establish as your guidelines and stick to those, once you learn all of this, it's maybe it seems a little complex to start, but I hope that I've distilled it, and my website has some more information to distill it into kind of a smooth process. Once you're up like that, I think it's kind of like you're up riding a bike, and you can take the training wheels off and just go from there. And it's really easy to implement, just like cash. It's really no different aside from those few rules you need to understand. And you can really make use of just the tiny bit of information you need to know to utilize previously existing accounts that you never thought you'd have access to.
Yeah. So a little plug or a little promo for you, Josh. I actually spent some time on your website, and for anybody after the show, after you hear today's episode, make sure to check it out. You've got a great blog, a lot of great articles on there. So great job on educating, the general public on just utilizing this strategy. So, not to tell everybody to go knock off what you're doing, but definitely serves as a good guide for those who are looking for ways to kind of provide good educational content to their investor database. So appreciate that. Good job.
Thank you.
Yeah, man, of course. Just send me my check in the mail later. Okay.
Will do. Yeah.
Well, cool. Well, that kind of leads me into your company, Walton Main. Tell us a little bit more about your company. Again, you've got some powerhouses in your corner, some of the partners that you're working with in the industry, some really big names there. So tell us a little bit more about Walton Main, kind of where you guys are going and what's on the horizon for you.
Yeah, absolutely. As we've mentioned, I specifically help folks with their retirement accounts, and I look for investments that are perfectly aligned for those retirement accounts. I exist within what you could call the think multifamily space. I'm, my mentor is Mark Kenny. And so I'm a part of a network of 60, 70 folks that, we're all very close, and we we're able to network multiple times a year, whether it's virtually or in person, depending on the year that you listen to this. And it's really nice because I have a greater connection to folks who are really hammering the pavement and the phones in certain markets that I necessarily don't have access to or as much experience with. And so I can really learn and leverage a larger network than I ever would have been able to on my own. So big advocate for mentorship groups if you want to get involved as an operator. But regardless, I'm specifically always looking for opportunities for my investors. I currently on my site not only have kind of lessons that Cody's mentioned, but I also offer a free PDF on the top 10 tips and tricks when investing in multifamily with a retirement account. And so kind of in that, I hope to, there are ways, we've talked about UBIT. There are ways to kind of get around that and maybe try to avoid it. And so I kind of note different ways that you can open up different accounts and take different approaches to maximize the overall potential in your accounts.
Like that. And I tell you, Josh, you have a very special skill set here in your understanding of leveraging your retirement accounts to do this, right? So for, I'd imagine that offers a great opportunity to partner with other people that, you have the ability to educate people and help them leverage their retirements. And so, whether it be capital raising, whatever the case may be, it's a very special skill set. So, really glad to hear that. And that's something that hopefully you can continue to leverage and, like I said, build on partnerships and relationships. And so
Thanks.
I'll keep that in mind as well. So
Sounds good. Yeah.
well, cool, man. Well, man, this has been a fun conversation. I know that sounds kind of funny, talking about self-directed IRAs, but I mean, again, very eloquently explained the dynamics here, and I think answered a lot of great questions that most people probably have. And for us as operators, I mean, it's good for us to kind of dive deep in here so we can better explain to our investors that we're working with about leveraging this. So I really appreciate that, man. I really appreciate the insight, and definitely look forward to learning more from you. But as we're nearing the end of our time here, I do have a couple more questions, and then we'll kind of wrap up. Okay.
Sounds great. Yeah.
So, all right, man. So tell us, what do you like to do for your continued education?
For my continued education, it's interesting. It's kind of evolved. I started with podcasts and, I got all the basics, but once you become an operator, I don't listen to podcasts as much. Kind of when I see an operator or someone with a special skill set that I want to listen to, I jump in. But I've really moved towards books and specific, topics that I'm really interested in at the time. And I found that it really is it's a nice opportunity to expand my mind. I was never really into books early on, and I've now read a couple hundred, and it's really nice.
Yeah, I love to read. It's just a matter of making the time, which I'm trying to get better at. But
Yes.
and speaking of that, do we expect a book coming on this topic from Josh
People have
Plave?
been telling me I should write one, and I guess I should do a little, a short ebook at some point and release that.
Yeah, man. Yeah, I'd be excited to see that come to fruition. But well, cool, man. So along your journey, what have been some of the most impactful lessons that you've learned along the way?
Yeah, the one that I people may have heard it before, but it's been really impactful for me is really focus on one thing. People get a lot of shiny object syndrome, especially when they have this entrepreneurial spirit and they want to, build something for themselves or for their family. And so, people might be doing. I talked to one guy. He does multifamily. He does office space. He does industrial. He does this and that. And like he's got his finger his hands in a lot of different pies, and which is great. But I like to really master one specific topic. Once I've built this company. So I spent the year building Walta, Maine. And now that I've built it, I can now pivot to the next potential topic. I can dive back into acquisitions now that I've built my capital raising business. And so, it gives you the opportunity to give 100% towards one topic and then start to focus on the next thing that you wanted to do, and that's going to help drive your business and focus 100% on that. So that's really helped I don't know, snowball effect my overall progress, and it's really done a huge number for myself.
Yeah, man, that's fantastic. I like that, and I wish I'd have heard that message, about 9 years ago when I had that shiny object syndrome myself and was just chasing after any and everything. It's easy to do. So,
Yeah.
but cool, man. So, any advice that you'd give to the listeners that they could help utilize to propel their businesses?
Uh, you know, I It sounds so cliche, but really just educate yourself and stay curious. The reason I got to the point I am with retirement accounts is because I didn't really want to accept everything I was hearing. I wanted to get the full perspective, and I wanted to build a clear understanding of what I needed to do and what it took to get what I was trying to do accomplished. And so just don't sit on your laurels. Always make sure that you're learning. A lot of the times it's tricky, especially in an environment as complicated as real estate, because you don't really know what you don't know. You don't know to look out for and ask questions about the topics that you're unaware of. And if you're not aware of these topics and you're not listening to as many podcasts as possible and tapping into as many experts in the industry, if you're not exposed to those things, then you're really going to miss out because you don't know the questions to ask when you're walking a property or when you're talking to a broker and come across as though you know what you're talking about. And so when you have that, you envelop yourself in the experience of being in real estate or whatever topic you're jumping into, and stay curious. It creates you become a more rounded individual.
Yeah, I really appreciate that, man. That's great advice. And I think it's important for the listeners to understand that even though it sounds cliche and even though you hear it over and over and over, there's a reason why you hear it over and over and over because
Yeah.
it's so important. It really is the foundation of success. When you talk about education and staying focused and disciplined. And so I really appreciate you hitting that home. So, all right, Josh. So tell us a little bit more about how the listeners can learn about Wall to Main and how they can get connected with you.
Yeah, you can go to my website, wall2main.com. As I mentioned, there's tons of videos. It's I did a little addition. And if you just have like a half an hour, you can watch 6 videos and it'll teach you everything need to know about retirement accounts. And you'll kind of have everything A to Z that you need to know. If you have any questions, you can certainly reach out to me there. And I just hope that even if you don't end up like investing with me or whatever, I hope to, kind of inspire some folks and just teach them what they can do with the situation they have in their hands.
Awesome. Well, Josh, really appreciate the conversation. Really appreciate all the great insight, man. Look forward to learning more about you and continue to watch your success. And I'll be looking forward to that ebook one day soon. So,
Yeah, I
but,
get ready.
but awesome, man. Hey, appreciate the great conversation.
Thanks, Cody.
Yeah.